Welcome to The Explainer. Today, we are digging deep into the tremors shaking the global economy and what looks like a major crisis brewing for 2026.
Okay, so let's just dive right in. You look at the headlines from early 2026, and it feels like a bunch of completely unrelated crises, right? Gold prices are through the roof, you've got protests erupting all over the world, and the markets, well, they're on an absolute knife's edge. But here's the question. What if these aren't separate stories at all? What if they're all just symptoms of one single massive problem?
To find that connection, we first need to get a really clear picture of the chaos that's happening right on the surface. These are the alarming symptoms of a system that is under some serious stress. I mean, think about what we've seen in just the first few weeks of the year. Gold didn't just break records, it smashed them. We've seen people in places like Kenya and Sri Lanka pouring into the streets, absolutely furious over tax hikes and austerity. We've watched markets just shudder. And on top of all that, trade wars are escalating, with blockades and export bans. It feels like a bunch of separate fires, right? But these are all just tremors from one single earthquake that's happening deep down in the financial system.
So now, let's look at the first huge clue to what's really going on beneath all this chaos. And it's a number so staggeringly large it's hard to even wrap your head around. This is where we have to start talking about debt. The absolute foundation of this crisis is debt. We're talking about global public debt, which hit an all-time high of $102 trillion back in 2024, and it just keeps climbing. Now, in a world of rising interest rates, this isn't just some abstract number on a spreadsheet, it is a crushing, unbearable weight, especially for developing countries where it's growing the fastest. But what does a number like that actually mean for real people on the ground? Well, for almost half the people on this planet, it means their governments are now spending more money just paying interest to their creditors than they are on doctors, on teachers, on hospitals. It forces this absolutely impossible choice. Do you service your debt, or do you serve your own citizens? You know, this isn't a new problem. This powerful question was asked decades ago by Tanzania's former president, and it has never, ever been more relevant. It just cuts right through all the financial jargon to the moral crisis at the heart of these numbers. It captures the devastating human cost when a nation's balance sheet becomes more important than its people's survival. So here's the crucial point. If all that debt is the dry tinder piled up everywhere, something else just lit the match. And that something is a little understood event that's happening in Tokyo, and it's acting as a global catalyst for all this chaos. See, for decades, Japan was basically the world's free money machine. Because its interest rates were parked near zero, big-time investors, we're talking hedge funds, corporations, you name it, could borrow Japanese yen for almost nothing. And then they take that cash and go buy everything from US stocks to crypto. This was the famous yen carry trade, and it was a huge source of fuel that pumped up asset prices all over the world. But now, that free money machine is officially shutting down. Japan is finally raising its interest rates, and that cheap ride is over. This is forcing a violent, rapid unwind. All those investors now have to scramble to sell their global assets, stocks, crypto, everything, so they can repay those suddenly very expensive yen loans. We could be looking at the forced selling of up to $400 billion in assets, which, as you can imagine, creates immense downward pressure on markets everywhere. And what's really wild is how these seemingly tiny numbers can be absolutely catastrophic for a country like Japan. I mean, with a debt that's over 260% of its economy, these higher yields are causing what you could call a fiscal heart attack. It's gotten to the point where interest payments alone could swallow the nation's entire tax revenue. This forces Japanese investors, who are the biggest creditors in the world, to sell off their foreign assets and bring that money back home. This great repatriation literally sucks cash out of the rest of the world, making everything that much tighter. Okay, so this brings us to two very different ways of looking at this whole mess. One perspective says this crisis isn't an accident at all, but the logical outcome of a system with a long and pretty brutal history. And then there's the other view, the more technical market perspective, which sees this as a major but ultimately manageable plumbing issue. Let's look at both. So according to the more critical view, the tools for extracting wealth have changed, but the game has stayed exactly the same. It started with gunboat diplomacy, literally France sailing warships to Haiti to force them to pay a crippling sum for their own freedom. In the 80s, it morphed into structural adjustment programs from the IMF, and today, we have things like digital redlining, where an algorithm can slap you with a terrible credit score, not because of what you did, but simply because of where you live, trapping whole communities in debt. The coercion is just as powerful, it's just invisible now, hidden inside a black box.
And this chilling quote from an anonymous analyst just sums that viewpoint up perfectly. It suggests this isn't a system that's broken. No, it's a system that's working exactly as it was designed to, where decades of built-up debt and dependency are now simply being harvested.
However, there is a very different take on this. A lot of market analysts would tell you the hysteria is completely overblown. They don't see this as another 2008 where everyone was going broke and couldn't pay their bills. Instead, they see it as a funding shift. The cost of money has changed, and that's forcing a massive repositioning of capital. In this view, the problem isn't that companies are insolvent, it's that their borrowing costs suddenly went up. It's a painful, messy plumbing issue for the market, they'd say, but it's an adjustment, not a sign the whole economic engine is about to seize.
So whether you see this as a deliberate harvest or a technical market adjustment, the immediate outcome seems to be exactly the same. A massive, massive shift in what we, as a global economy, actually value. The ultimate consequence here is what you could call a great repricing of everything. As confidence in the entire debt-based system of paper assets, stocks, bonds, currencies, starts to crumble, wealth is literally fleeing to the physical world. It's moving into hard assets like gold, silver, minerals, and energy, things you can't just create with a keystroke.
And you can see the potential scale of this shift right here. Gold, which has always been seen as the ultimate insurance policy against governments going broke, has projections that start to approach $5,000 an ounce. And silver, which is really unique because it's both a monetary metal and a critical component for the green energy transition, also has these incredibly bullish forecasts. This isn't just speculation, it's a powerful vote of no confidence in the entire paper-based financial system. And that leaves us with one final and I think really provocative thought. If that analyst was right and the system was designed for a harvest, what happens when the crop refuses to be gathered? As we see developing nations starting to talk about forming debtor unions, about demanding debt abolition, they are challenging the very foundation of this 200-year-old system. So the real question for 2026 is no longer if the system will be tested, but whether it can possibly survive when the crop refuses to be gathered.